Gemini Space Station completely missed consensus expectations for their Q2 2026 earnings. They reported an earnings per share of negative 89 cents, which blows right past the street's estimate of negative 57 cents.
Yeah, that is a massive 56.1% negative surprise.
Exactly. And on the top line, revenue came in at $45.5 million. I mean, that is a 37% increase year over year, but it still slightly missed the 46 million consensus estimate.
Right, and management just straight up declined to provide any formal revenue guidance for the rest of the year.
Which investors never like.
No, they hate it.
Hmm.
The company only narrowed their expense targets. So technology and G&A expenses are expected to land somewhere between $155 million and $170 million. Stock-based compensation is guided at like $100 million to $115 million.
And they also said cash compensation is expected to decline 15 to 20% compared to 2025.
Right.
So unsurprisingly, the market reaction was swift and pretty unforgiving. Shares plunged 6.74% and pre-market trading down to 4.01. Yeah, it's dragging the stock dangerously close to its 52-week low of 3.74. And if you zoom out, you're looking at an 86% collapse in the stock price over the past 12 months.
It is just a staggering destruction of shareholder value for a company that, went public with so much momentum.
But there's this weird paradox in those headline numbers we just went through. They grew top-line revenue by 37%, yet their bottom-line losses accelerated way past Wall Street's worst fears.
Yeah, it doesn't intuitively make sense.
Right. It's like, imagine walking into a massive, multi-level flagship department store. The lights are on, the shelves are totally fully stocked, but the aisles are completely empty.
Just a ghost town.
Exactly. Nobody is buying a single piece of actual merchandise. Yet the store claims it's having a record year. How?
Because it's surviving entirely off the high-interest credit cards it aggressively pushed on customers on their way out the door last year.
That's exactly the situation Gemini finds itself in right now. So for this deep dive, our mission is to look past these top-line illusions in the earnings report. We need to figure out if this company is executing a genius sustainable pivot or if it's just quietly bleeding out.
Right. Masking the underlying trauma. And those empty aisles, in your analogy, that perfectly represents Gemini's legacy exchange business. The core engine of this company has essentially stalled out.
Stalled is almost putting it mildly.
Yeah, I mean, exchange revenue dropped 38% year over year to just $12.5 million. And the underlying trading metrics are even more alarming than that. Spot trading volume just cratered by 66%, falling down to $3.8 billion.
And that evaporation in volume is directly tied to the broader macro slide in the crypto market, right?
Absolutely. The data here shows Bitcoin fell from its $117,000 peak in late 2025 to below $60,000 by the end of this second quarter.
Right, the classic crypto winter dynamic.
Exactly. And in traditional equities, when the market drops, you still get heavy trading volume. Institutions are rebalancing, algorithms fire, you have traders shorting the market.
But retail crypto is just entirely momentum-driven.
Yes. When the euphoria stops and prices fall, retail investors don't generally short the market. They just close the app and walk away. So spot trading, the actual matching of a buyer and a seller for a token, it simply dries up.
But total revenue still grew 37%. So where is all that money actually coming from?
It's all concentrated in their services and interest income segment.
Which is wild. This segment surged 117% year over year to $26 million.
Right.
You have to think about that structural shift. Services and interest income now account for 59% of Gemini's total net revenue. The breakdown is honestly fascinating.
Yeah, walk us through those numbers.
So credit card revenue jumped 231% to $16.2 million. Over-the-counter or OTC revenue for institutional whales that climbed 671% to $4.7 million. And staking revenue hit $4 million, which is an 88% sequential jump.
We should really pause on that staking number because it perfectly illustrates the psychology of the retail investor in a bear market. Well, why does staking revenue jump 88% while actual trading volume drops 66%? It's because when retail investors see their portfolio crashing, they suffer from massive loss aversion.
Right. They refuse to sell their tokens at a loss.
Exactly. Instead, they lock up their coins, they stake them on the blockchain network to earn a passive yield while they just wait for the market to eventually recover. And Gemini facilitates that lockup and, takes a very healthy cut of that yield.
So the only weak spot in their services portfolio was custodial fees. Those shrank 67% down to $0.6 million.
Which makes sense.
Yeah, that is purely a function of the underlying assets just being worth less, combined with institutional net outflows. But Looking at this massive shift in where their money comes from, I have to be honest, I just don't buy management's framing of this as a triumphant diversification story.
You think it's just survival?
Pure survival. They are clinging to the life raft of credit cards because the core crypto exchange is practically dead.
I mean, I hear you, but I think you might be dismissing some of the strategic foresight here. Yeah, if you look closely at the timelines, they spent the capital to build out this credit card and staking infrastructure well before the market actually crashed. They knew crypto winters happen.
Okay, fair point.
So it's not just a life raft they happened to find floating by. It's one they intentionally built for this exact scenario.
Sure, but the velocity of the collapse basically forced these secondary services to become the primary load-bearing pillars of the entire company. And here is the fundamental problem with that. Shifting from a transaction fee model to a credit product model, it changes your entire corporate identity.
Oh, totally.
You aren't just a neutral toll booth collecting a tiny fee when a buyer meets a seller anymore. You are a lender now. You are taking on default risk. You are completely altering your balance sheet risk.
And that profound shift in risk profile is exactly why the EPS miss was so massive this quarter.
Right, because when you become a credit issuer, your cost structure changes dramatically.
Exactly. Now, management did try to get ahead of this with some really aggressive operational cost cutting. Total operating expenses actually fell 15% sequentially, down to $122.4 million.
They executed a pretty massive restructuring, right?
Huge. They brought total headcount down to just 402 employees. That is a 40% reduction from their peak headcount back in the third quarter of 2025.
Right, and the operating loss did improve on paper because of all those cuts. It narrowed by 18% sequentially to $76.9 million.
So they're clearly hacking away at the bloat.
They are, but, and this is where the earnings report gets incredibly frustrating for investors, despite dropping operating expenses by 15%, their adjusted EBITDA loss actually widened.
Yeah, that's the painful part.
It went from a $51.9 million loss last year to a $74 million loss this quarter. Like, how do you slash your workforce by 40%, aggressively cut your expenses, and still lose over $20 million more than you did last year?
It all comes back to that balance sheet risk we were just talking about. Management explained on the call that the EBITDA result was heavily distorted by a non-cash mark-to-market loss.
Ah, right, the Bitcoin investment.
Yeah, they made a strategic $100 million Bitcoin investment back in May. And because Bitcoin's price dropped between May and the end of June, standard accounting rules require them to recognize that paper loss on their income statement.
So they didn't even sell it?
No, they didn't sell the Bitcoin, but they still have to record the drop in value, which completely drags down the adjusted EBITDA.
See, that is infuriating from an operational standpoint. It's like spending 6 months ruthlessly optimizing your household budget. You cancel your streaming subscriptions, you stop eating out, you bring your grocery bill down by 15%.
You're doing everything right.
Right, you are doing everything right operationally. But you live on a sinkhole, and the foundation of your house just gave way, wiping out $100,000 in home equity anyway. All that extreme cost discipline is completely overshadowed by a massive balance sheet hit.
Yes, it is. But you cannot really blame the sinkhole when you intentionally chose to build your house on top of it.
That is a very fair point.
In the crypto industry, treasury management is a core operational function. If management decides to park $100 million of company cash in a highly volatile asset like Bitcoin, they are explicitly accepting that volatility into their earnings profile.
You can't have it both ways.
Exactly. You can't ask Wall Street to ignore the losses on a strategic investment while simultaneously marketing your pure-play crypto exposure as a core strength to your users.
So as an investor looking at these reports, you really can't separate the two. Holding $100 million in volatile Bitcoin completely negates the operational discipline of laying off 40% of your staff.
Precisely. The 15% drop in operating expenses proves that management can execute a reduction in force. But the widening EBITDA loss proves that their overall financial health is still entirely tethered to the price action of Bitcoin.
Regardless of how many employees they let go. And management clearly knows they can't just pitch, we fired people and Bitcoin went down to Wall Street forever. You cannot shrink your way to greatness.
No, you desperately need a growth narrative.
Right. And in the earnings call, the Winklevoss twins were aggressively pushing a strategic pivot away from being a pure-play crypto exchange.
Oh yeah, the inescapable buzzword of that entire call was super app.
Of course it was.
Cameron Winklevoss explicitly stated they are building a financial super app for the markets economy. They are trying to vastly broaden their appeal by offering over 5,000 tradable markets now.
Which goes way beyond just Bitcoin and Ethereum.
Oh, way beyond.
On the equity side, they launched zero-commission U.S. stock trading in July. And for derivatives, their in-house derivatives clearinghouse is now fully live.
Right, and they noted they're just waiting on CFTC approval to launch perpetual futures for U.S. customers.
Which Tyler Winklevoss apparently views as a massive catalyst. Plus, they are pushing heavily into prediction markets, right?
Yeah, event contracts traded on Gemini were actually up 93% quarter over quarter, passing 225 million cumulative contracts.
Okay, so the operational theory here is cross-selling. You come to the Gemini app to bet $50 on a presidential election or like a sporting event. You stay to buy some zero-fee Tesla stock, and eventually they upsell you to the Gemini credit card.
That is exactly the playbook.
Oh, we're sorry, but looking at these numbers, this sounds like pure desperation to me.
Really?
Yes. Every struggling fintech company over the last 5 years has suddenly decided they are building a super app, adding zero-fee equities. That is a notoriously low-margin, hyper-saturated bloodbath of a market.
I mean, you're not wrong about the competition.
You are going up against Robinhood, Schwab, federally institutions with infinitely deeper pockets and established user bases. I look at this and I just think management is throwing spaghetti at the wall to distract investors from the fact that their core crypto spot volume dropped 66%.
I actually have to disagree that it is just spaghetti on the wall.
Okay, sell me on it.
If you look closely at the strategy outlined by analysts, the zero-fee equities product is not designed to be a revenue driver at all. Management explicitly admitted on the call that it won't materially impact revenue this year.
So it's just a loss leader.
Exactly. It's designed to lower their customer acquisition cost. Right now, trying to acquire a hardcore crypto trader in the middle of a bear market is incredibly expensive.
So you get the users in the door as cheaply as possible.
Precisely. Luring a retail user in with free Apple stock or some viral political betting market is cheap. But the real crown jewel in this super app strategy, the part that actually could build a massive competitive moat, is the derivatives clearinghouse and that push for perpetual futures.
We should probably explain the mechanics on that for you listening, because perpetual futures are fundamentally different from just buying and holding Bitcoin.
Right. If you aren't trading crypto 24/7, a perpetual future is essentially a futures contract that never expires. It allows traders to use massive, sometimes 100x leverage to bet on price movements without ever touching the actual underlying asset.
It is the absolute high-stakes casino of the crypto world.
It really is. And globally, the vast majority of price discovery and trading volume happens in perpetuals, not spot trading.
But historically, those markets have largely been offshore and completely unregulated, right?
Exactly. So if Gemini secures the CFTC license to offer perpetuals to U.S. retail customers, that is a high-margin, incredibly high-volume monopoly with immense regulatory barriers to entry.
Okay, I see the vision now. The super app with free stocks and prediction markets is really just the shiny storefront. It's designed to herd retail liquidity into their proprietary high-margin clearinghouse in the back room.
That is the big play. But, and this is a huge but, having a grand structural vision requires flawless execution.
And if we look closely at the notable risks buried in this Q2 report, their execution is currently deeply flawed.
Deeply flawed is putting it nicely.
Right. This is the most glaring operational misstep in the entire earnings report.
Right.
We talked earlier about how credit card revenue was the star of the quarter, up 231%. Well, transaction losses jumped from $3.6 million last year to an astronomical $20.1 million this quarter.
It's a staggering jump.
And when you isolate the reason for that spike, it is alarming. It includes a $16.1 million provision for credit losses tied directly to an identity fraud event in a Q1 2026 origination cohort.
Yeah, let's break down how this works mechanically. Identity fraud in credit origination usually means a sophisticated ring used stolen or synthetic identities.
Like mixing real Social Security numbers with fake names.
Exactly. They use them to apply for Gemini credit cards, they get approved, they max out the credit limits, and then they vanish. And the delinquency rates tell the whole story here.
What were the rates?
So normal people falling behind on their bills, the non-fraud delinquency rate was 3.3%. That is entirely manageable for a young credit portfolio. But the fraud-related delinquencies surged to 6.1%.
Which is catastrophic for a lender.
It is. And because of CECL accounting standards, which stands for Current Expected Credit Losses, the moment management identifies the scope of the fraud, They have to take the hit for all the expected future losses immediately.
They can't just amortize it over time.
No, they cannot. That is exactly why a $16.1 million chunk hit the Q2 earnings all at once.
That massive credit provision really is the smoking gun of this report. Think about it. Gemini is pivoting their entire strategy around reputation.
Right.
They are asking retail investors, institutional whales, and federal regulators to trust them to run a comprehensive financial super app and a highly complex derivatives clearinghouse. But they just let an identity fraud ring walk away with $16 million because they couldn't secure the basic onboarding funnel for a standard credit card.
It's not a great look.
No. If you can't lock the front door, why should anyone trust you with the vault?
And that exact execution risk is why Wall Street took a sledgehammer to the stock after this print. Analysts absolutely despise execution surprises, especially when it comes to credit risk.
Yeah, Goldman Sachs really did not hold back.
They downgraded Gemini to a sell rating with a $4 price target. They specifically pointed to extreme difficulties in the company's ability to ever reach positive adjusted EBITDA.
Given these operational unforced errors.
Right, combined with lower than expected customer growth.
And looking at the bar chart technicals, the charts reflect that pessimism entirely. Bar chart is screaming a 100% sell signal right now. The stock is completely broken down. Fundamentally, it is trading below its 20-day, 50-day, 100-day, and 200-day moving averages.
Plus, the broader macro environment is not offering any cover for their new product lines either.
You mean the regulatory headwinds?
Yeah. The New York Attorney General is actively suing prediction market competitors like Kalshi, arguing that event contracts are simply illegal gambling.
Oh, wow.
So Gemini is banking a significant portion of its user acquisition strategy on a product category that is currently under existential legal threat in the financial capital of the world.
So we are really looking at a company trying to perform a mid-air engine swap while the plane is actively losing altitude.
It's a great way to put it.
They grew top-line revenue by 37%, only because they are squeezing yield out of credit cards and staking, while their legacy crypto spot volumes completely evaporated by 66%.
Yep.
They laid off 40% of their staff to cut costs, but their EBITDA losses still widened to $74 million because they held volatile Bitcoin on their balance sheet.
And took that mark-to-market hit.
Exactly. And while they're pivoting hard into a zero-fee stock and prediction market super app, they are bleeding cash from a $16.1 million identity fraud failure.
Look, the licenses and the infrastructure for that derivatives clearinghouse are genuinely valuable assets, provided they actually get the CFTC approvals for perpetual futures.
Right.
But the cash burn is intense, and the market's patience for these execution missteps is completely gone.
Which leaves you with a lingering question to mull over as you assess your own portfolio. If the broader crypto market remains sluggish, and Gemini's traditional spot trading volume never returns to those dizzying 2025 peaks, is this company destined to become just an unprofitable credit card and prediction market business, masquerading under a legacy crypto brand?
It's the multi-million-dollar question.
Make sure to follow the show for daily earnings coverage.